So is that what's in store for the housing market this year? Well, opinions vary, but it's an important question for investors. Some analysts see the housing market as a promising indicator of a recovery in 2021, while others see it as a ticking time bomb. It's that time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. Despite the coronavirus crisis, and in some ways because of it, the housing market boomed in 2020. Although home buying briefly paused last spring due to uncertainty and, of course, the lockdown that we all went through, 2020 was ultimately a record-breaking year for residential real estate. But despite the ongoing recession, home prices have continued to rise in early 2021. So, in short, the housing market has emerged as a pillar of support for an economy that's still struggling in many ways. So the questions are, will that support continue? And we'll explore that question and many others right here on today's show, including trying to identify which forces are driving the current housing boom and what things could potentially cause the boom to go bust. How might the face of the housing market impact the financial markets overall and possibly your portfolio? And we'll be talking to Dr. Ben Carson, now former Secretary of Department of Housing and Urban Development. Then my co-host Jeff Small will join us to give us his breakdown in the housing market. And later in the show, we'll talk to Florida-based financial advisor Michael Eastham. But first, let's take a minute to look at the housing market and how it managed to soar last year, and how it managed to do this amid one of the greatest economic challenges that our country has ever faced. You know, although millions of Americans were laid off, or furloughed, should we say, euphemism oftentimes for being laid off, due to this pandemic, that still hasn't stopped house hunters from buying homes and doing it in record numbers across the United States. As a result, the housing market saw its highest pace of growth since the now infamous housing boom of 2006. Now, I say infamous. Why? Because, as everyone knows, that boom was driven by reckless lending in this thing called the subprime mortgage market, right? And the 2020 boom, though, was different because it was driven on high demand and record low mortgage rates. And both of those factors were propelled by the COVID-19 crisis, which is why I said earlier, the housing boom has occurred both despite the pandemic and in some ways because of it. But the fact remains that housing prices had already started to rise before the coronavirus. However, the pandemic did create a rapid acceleration from single digits to double digits. The pandemic also contributed to an outbound migration from cities, which seems to be an ongoing trend. In fact, several surveys indicate that interest in homes located in rural areas and in the suburbs has spiked, while interest in urban areas is down. So overall, the housing market has seen record-breaking growth, really, if you think about it, since last June, which is when most areas of the country began reopening after the initial lockdown. As prices have continued rising month after month, to me, it shows the resiliency of the housing market, even in the face of the ongoing recession. In many ways, the housing market has performed a lot like the stock market during the pandemic. In other words, far outpacing the economic recovery as a whole, and possibly for similar reasons. Record low interest rates, we mentioned, were perhaps the number one reason. Demand for homes is still outpacing supply, and that's a strong indicator that this trend will continue. Now, the pandemic has hindered the ability of home builders to put up new homes, and the housing market, therefore, is already running short of previously owned homes. That helps the prices increase even more. The number of current homes being put on the market has plummeted and remains down about 30% from the norm. And this has left the market with nearly twice the demand, yet perhaps only maybe 2/3 of the supply. And as a result, both the inventory of homes and mortgage rates are now at historic lows. In addition, the lack of developed land available for new suburban homes means builders might continue struggling to keep up with demand. And as a result, home prices could continue to rise in 2021 as long as some other issues don't occur, causing the boom to go bust. Now it's time to bring in our first guest, a repeat guest here for the Income Generation, and one of the nicest people that I've had the pleasure of interviewing, as I stated back in May, right to his face, and that is Dr. Ben Carson, now former Secretary of Housing and Urban Development. Before he was Secretary, Dr. Carson spent nearly 30 years as Director of Pediatric Neurosurgery at Johns Hopkins Children's Center. Dr. Carson, thanks so much for being back with us here on the Income Generation.
Well, it's wonderful to be with you again. Thank you.
So a lot has changed since May. Your appointment is now ended. How do you think President Biden's handling of the coronavirus crisis will be different from President Trump's, and what does it mean for our country?
Well, first of all, I'm very happy that we were able to get a vaccine. It makes all the difference in the world because, it's called the novel coronavirus because it's new and it doesn't act like anything that we've ever seen before. And one of the things that's vitally important is that we build on what each other knows. Rather than get into our respective corners and point fingers and say, well, you should have done it this way. Let's just learn as we go and build on that so that we can get the people a cure.
Sure. So how long do you think it'll take before we get to that goal of herd immunity between those who've had the virus already and recovered, those who get vaccinated? What's your best guess in terms of time frame?
Well, I suspect probably late summer, early fall. It's going to be a combination of people who've had it already and people who get the vaccine. I've had it already. I almost died from it. But in a way, it's very relieving because I can't give it to anybody and nobody can give it to me. So that's good. And that's the way we hope the whole population will be by that time.
Sure. And it's only relieving, of course, because you didn't die from it, right? So now hindsight makes it a relief. But I'm sure you had some scary moments when you went through it. I've talked to people all the time that have gone through it. So God bless you. You made it through the other end.
Thank you.
What could go wrong with the vaccine? These other strains that maybe the vaccine becomes less effective with. What could go wrong to push this end of the summer timetable back?
Well, obviously there could be logistical problems that impact our ability to give the vaccine. But, obviously the big worry is that we get a new strain that is not amenable to vaccinations that we're giving. That would be a real disaster. Or, maybe where this one came from, maybe there's another one being worked on to release. I don't know. But we should entertain all possibilities and be ready for every eventuality. And as these new strains are coming up and we say, well, the vaccine still covers them, let's also be looking at other alterations in the vaccine that we might be able to make so that we are ready when other things happen.
Yeah, it sounds like you're not totally ruling out the theory that the virus was created in a laboratory somewhere, as many are not ruling that out either. So, how about the state issue? We have people from New York that are coming down to Florida to try to get vaccinated because it's easier to get vaccinated here. There's more red tape in other states. Initially, I know you were a fan. I know you don't want to get political, but initially you were a fan of saying, hey, let's let's let each state make their own decisions. But now that we have a vaccine, is that the right avenue now in terms of vaccinating people, or maybe the federal government needs to take a more proactive role if they legally can?
No, I think actually federalism is the way to go here. Let the states and localities do it. And take one layer of bureaucracy out will increase the efficiency quite significantly. And we've got 50 states, which means we have 50 laboratories. And let's see who's doing it the best. What are the tactics that they're using? And then let's use that everywhere. That seems to make a lot more sense.
Like you said, let's learn from others. I love it. It makes sense when it comes from one party versus the other, and it makes sense state by state also. So we need to take a quick commercial break. We'll be back with much more here in a moment with Dr. Ben Carson. I'm David Scranton on the Income Generation, and Dr. Carson and I will be right back. Welcome back to the Income Generation. I'm David Scranton, and I'm so pleased to be here with our special guest today, Dr. Ben Carson, former Secretary of the Housing and Urban Development. So, Dr. Carson, let's pivot now. We talked about the virus itself. Let's pivot to the topic of the day on our show, which, as you know, is the real estate market. Real estate was looking like it might have some struggles. We spoke back in May because we had just come out of that first level of shutdown when we shut down the economy intentionally. But now real estate is booming. Good thing, bad thing? Are we in a bubble? Are we not in a bubble? What's your best guess there?
Well, right now the interest rates are still very low, so that's conducive to a booming market. But also there have been some real dynamic changes in where people want to live, because something has happened that probably will alter our society forever. And that is, remote work. And if you only have to come into the office once a week or once every other week, it now makes sense to move out and to move 20 or 30 or even 50 miles away. It's not a problem. And therefore, we see a lot of new homes being constructed, in the exurbs and in the rural areas. And people are obviously wanting to be free. They want to be able to walk around maskless and not be infecting anybody. So that is probably going to continue to encourage a strong housing market for some time to come.
Now, as the former head of the Housing Urban Development, you are really an advocate for folks who, may have a tough time, buying a property or living the American dream, so to speak. So the goal was to make sure that, they had a path toward that. Now we're worried about inflation, perhaps, with all the printing of money that's been going on, and that seems to like it's just going to be accelerating under the new administration, as well as these real estate prices going up. That kind of sort of makes it harder for a lot of folks to live that American dream, does it not?
No question, that makes it more difficult. And what we have to recognize about housing is that it is the principal mechanism for wealth accumulation in this country. The average homeowner has a net worth of $200,000. The average renter a net worth of $5,000. So it makes all the difference in the world. And we need to concentrate on removing the barriers, the obstacles, the disincentives, and there's a lot.
How do we do that, though? How do we remove those barriers?
Well, it's going to require the politicians to help remove some of the barriers and to change some of the policies. For instance, if you're getting housing subsidies and you make more money, you have to report that immediately so your rent can go up. Or if somebody else moves into the housing who has an income, you have to report that so that your rent goes up. This discourages families, family formation. Those kinds of things have a huge impact on whether an individual subsequently gets into that pool of people who's eligible to actually buy a home. So we have a lot of barriers at the beginning that keep people from ever even considering becoming a homeowner. And those are the kinds of things that really have a very negative impact on the income gap.
Sure, sure. You know, it's interesting because right now in the early days of the Biden administration with some of the executive orders, some of the things that I see the new president moving toward is something that to me is somewhat akin to affirmative action. And I know from speaking with most of my African American friends that a lot of them really aren't big fans of affirmative action. Your thoughts on the direction in which we seem to be heading over the last couple of weeks?
Well, it's a little concerning because what we are tending to do as a society recently is define everything in racial terms and in identity group terms, rather than, out of many one, we're saying out of one many. We're just dividing everybody up and creating exactly the opposite situation that Dr. Martin Luther King dreamed about. And they seem to be celebrating that. We don't really want to go there. We want to really start thinking about what are the things that create equality and fairness for everyone. I wrote an op-ed some years ago about compassionate action instead of affirmative action, which means, of course, we as Americans have always had compassion for the disenfranchised people. I think we should continue to do that, but that should have nothing to do with one's exterior characteristics. That should have to do with one's circumstances.
Very well said. I love it. All right. So Dr. Carson, it's great having you here. Thanks so much for being part of our show. We really appreciate it. We hope to have you back.
A pleasure. Thank you so much.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. Now let's take a minute and talk just a little bit more about the housing market. Will it collapse this year in 2021? Well, the answer to that question really hinges on whether or not what we're seeing currently is indeed a bubble. So let's talk more about the definition of a bubble so we can determine if we're in one. A bubble is generally defined as any asset class when a run-up in prices is driven by high demand, exuberant spending, and ultimately speculation. And bubbles by their very nature are destined to burst, as the 2006 housing bubble did with disastrous results. The current housing boom does have some characteristics of a bubble, such as being fueled by high demand. Beyond that, though, most analysts agree the current housing market might very well not be a bubble. It might just be another example of how the pandemic has strengthened and has sped up an economic trend that was already underway. Now, other examples include the trends toward home shopping and telecommuting and advancements in communications technology, things that we've discussed on recent shows. The acceleration of these trends has helped certain businesses and certain economic sectors actually thrive during the pandemic, just as the housing market is currently thriving. So with the Federal Reserve committed to keeping interest rates low and demand expected to remain high, the housing boom is widely expected to keep thriving in 2021. Now, this isn't to say that there aren't factors that could weaken it, such as the potential of another widespread lockdown and therefore an economic setback that's caused by the pandemic. Another might be the potential for an affordability crunch to occur. Although mortgage rates are at record lows, some analysts believe they may rise modestly in the coming months. A combination of rising rates and increasing home values could potentially price out some buyers, so really price them out of the market entirely during the all-important spring sale season. Now, an additional danger is the potential of another stock market correction, which some analysts believe is possible by mid-year. Let's face it, buying a home is one of the biggest financial decisions there is, and people are less inclined to do it when they're worried about their 401ks being down as well as other investment portfolios being down in value. And a market downturn could trigger that worry. Could trigger the worries that potential home buyers end up really putting a stop on their goal of purchasing their dream home. And that in turn could increase Wall Street's worries and could deepen the downturn. Essentially, it can create a vicious cycle. And we'll talk more about that and other ways in which the housing market could potentially affect the broader financial markets, but most importantly, how the housing market could affect your portfolio. And we're going to be hitting this coming right up after the break. Plus, my co-host, Jeff Small, will be joining us, and we'll get his take on the housing markets. And later in the show, Florida-based financial advisor Michael Eastham joins us. We'll be back in a moment, right after the break, here on The Income Generation. Welcome back to The Income Generation. I'm David Scranton, and it's great to be here today with you to discuss a topic that directly or indirectly affects almost every member of the income generation, and that is the subject of the housing market. You know, earlier we talked about why some analysts believe we're in a bubble that is destined to burst. However, many analysts tend to disagree, and there's some evidence to support their theories. For one thing, we haven't seen the kind of overbuilding that usually precedes a bust. It's quite the opposite, in fact. As I mentioned earlier, builders are actually struggling to keep up with demand. And we also haven't seen a big relaxation in lending standards, and certainly not the kind of reckless lending practices that led to the historic 2007 housing market collapse. In fact, the subprime mortgage market never really returned after that crash. And today, even some borrowers with good jobs and good credit struggle to get a mortgage. So there are a lot of factors in place to indicate the housing boom is really not a bubble, but instead just another economic silver lining in this pandemic dark cloud. This isn't to say that a crash is out of the question. As with the stock market, the performance of the housing market has been reassuring in one aspect, but quite illogical in the other, when you compare it to the broader economic picture. Yes, unemployment has improved dramatically and somewhat steadily since the peak of the pandemic last spring. But jobless claims have been creeping back up in recent months, and many businesses have continued to struggle. So far, Wall Street has ignored this, and has also ignored other troubling data, and instead has chosen to focus on the promise of more economic relief coming from the Biden administration and the Federal Reserve. Big investors may be able to continue doing that, at least until the vaccine takes effect and the economy is fully recovered, in which case, perhaps we might just avoid another major market pullback. Or, as I've discussed on last week's show, by mid-year, investors might shift their focus away from stimulus and all the positive stuff toward the prospect of President Biden's broader economic policies, such as more regulation and raising tax rates, in particular the corporate tax rate. And that could easily trigger another market correction. Many analysts believe that it will. Now, while that may not be enough to cause the booming housing market to go bust, it could certainly cause it to deflate, which could then feed into Wall Street's fear and drag the stock market down further. Or if the housing market should somehow go bust first, and that has the potential to be a tipping point for the next stock market correction. So here's the point. Bubble or no bubble, anything is possible in today's financial markets. Right now, I'd like to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. Jeff is also author of the Amazon best-selling book entitled Turning Financial Planning Right Side Up. So Jeff, how's your elbow feeling after reeling in all those huge 5 to 10 pound kingfish that we reeled in last weekend? Are you as good as new by now?
Oh, yeah. I mean, that was really tough work, Dave. Those fish were so big.
Exactly. So, housing market. What do you tell your clients that come in the office, when if they're looking to downsize because they're retiring, or maybe they're looking to buy a second home? these prices that seem to be just going up, up, and up, I mean, does it hurt them? Does it help them? Does it make a difference?
Well, it's a personal preference. Most retirees love to have a house that's paid off, even though now with rates being so low and money so cheap, a lot of retirees can get a house that's way more than what they expected in retirement because money is really not expensive with rates being so low. And there's a huge move, Dave, for hard assets. Everybody wants to own hard assets today.
Mm-hmm. Yeah, if they're willing to take a mortgage, absolutely. Well, I always tell people, if they're downsizing, it's great, right? Because they can get more money for the more expensive house because prices are high. Yeah, they have to pay a little bit more for the smaller house, but net, it's a plus. But how about some of the people who, might be looking at buying a second home, maybe coming down to Florida and being your neighbor or my neighbor and being snowbirds?
No, that's a really good point.
How does it affect them?
Yeah,
when they have that dream.
That's a really good point, Dave. I mean, there's a huge trend in real estate right now as people migrate. And we're starting to accept the fact that the COVID virus is going to be here for 5 to 10 years. So there's a huge trend for outbound properties and vacation rentals and having second homes in different locations that are away from, densely populated areas. And I think that trend is going to be here for a while. And with money being so cheap, there's huge demand and for properties, very low inventories, very high prices. And so if you've got a chunk of change that you can put down, you can make the payment affordable. But if you're going to finance the majority of it, generally will not work for most folks, even in this low rate environment, unless they have lots of excessive surplus, income and cash flow per month.
Yeah, it's right. If it's a mortgage equation, the increased prices kind of negate the fact they can get cheaper payments, lower interest rates. But then again, with the supply of real estate being down, if you see these prices getting run up, there's a chance for more inflation. I know we don't think it's going to be crazy. Some people think it could increase, but inflation could work against the cash buyers, the people like our clients that really don't want to take a mortgage, right? I mean, that's ultimately that's the big negative from what I see.
It really is. I mean, retirees are so resistant to having any debt. And they've been taught that when they retire, they should be debt-free to keep their expenses low and their income high. And that's where, 90% of them will go. But I've got a few retirees, Dave, that are living on the edge and saying, look, I've got a good income. I can afford that, $800,000 house or that $1 million house. I'm going to go ahead and do it because money is so cheap right now.
Yeah. Yeah. So, it's funny. We had an interesting conversation just last weekend fishing in the Florida Keys about rental properties. And, my concern was that, gosh, people aren't going to travel as much anymore. So it's possible that, the rental market could suffer because people aren't traveling. But you had a diametrically opposed view of rental properties, if purchased in the right area. And I kind of thought that interesting. Do you mind sharing?
Well, sure. So in areas that are pretty, that people like to visit, like the mountains in North Carolina, or maybe Daytona or the Keys, where you've got a large flow of people coming through there, it's very easy to rent those properties now. Not Airbnb type properties, but vacation rental by owner type properties are really going to be kind of all the rage. If you want to own hard assets, have the property cover its own expense. With renting, you generally only have to rent it 3-4 months a year to break even. And so that's a nice way to be able to pay for the property, have a second property, and not have any expenses, but still enjoy the amenities of having that kind of an asset. And again, there is a move when market values get this high, Dave. We want to be in hard assets. We want to own things like real estate.
Well, and what I love about it too is the fact that, what you said was, look, if people aren't going to be flying as much for vacation, when they fly, they can't take a lot of stuff with them, so they need the amenities of the hotel. Now they're a little afraid of flying because of the virus, maybe afraid of staying in a hotel. And they're driving. And when they're driving, they're bringing stuff with them. And that gears itself more toward home rentals. So you're right. As usual, it's about location, location, location. But I love your philosophy. And you even got me last weekend thinking about, having a rental property as an investment. So awesome. I love it. Don't go away. When we come back, we'll share a few thoughts on how the booming housing market, how it could impact investors in or nearing retirement. Just like we've talked about, we're going to continue that conversation. Plus, we're going to bring in our next guest, our good friend and financial advisor extraordinaire, Michael Eastham, just in the Orlando area from Florida. Stay with us. We'll be right back here on The Income Generation.
behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Don't waste any more time. Visit myfreeretirementreview.com to find out if you have the right retirement strategy in place.
Welcome back to the Income Generation. I'm David Scranton, and today we're talking about the ups and downs of the housing market and why some analysts believe we're in a bubble with real estate that can burst, while others are saying that we're not. So now let's take a minute and let's focus on how all of this can affect your retirement goals. If you're like millions of other Americans, your retirement plan might just include selling your house and downsizing at some point in retirement. Now, obviously, that plan benefits greatly from a booming housing market. In fact, if your plan were to sell within the next couple of years, it might even make sense to consider moving up your timetable and taking advantage of the current real estate market. The right financial advisor can help you make that determination. How? By examining it alongside your retirement goals and your broader financial strategy. The right advisor can also help you determine other potential ways to take advantage of today's markets and to make sure that you have a portfolio that's aligned with your personal risk tolerance and your goals. I've talked about the importance of reviewing your risk tolerance quite a bit recently. And the reason is because it's really important in the current market environment. I've described that environment as, to quote Charles Dickens, the best of times and the worst of times. And like the soaring stock market, the booming housing market is another example of what's best about these times. Now, on the flip side, the fact that we're still in a recession and in the grip of a global pandemic that could worsen and could send the markets tumbling again has made analysts at least sit up and take notice. So it's important to know, is your current strategy designed to help protect you enough from that potential risk? Or could you take steps to help protect yourself further? Would you like to make changes to increase your risk a bit to take advantage of potential opportunities that could emerge from the next downturn? Whichever you choose, the only way to know for sure is by re-examining your strategy and doing it with the help of the right advisor, one who specializes in retirement income. Now it's time to bring back in Jeff Small, as well as our next guest, a good friend of yours truly, Michael Eastham, founder of Fellowship Financial Group, a retirement income store located right near Orlando, Florida. Michael is also the author of the book, Common Sense Income Strategies. So Michael, first of all, great to have you back.
Good to be here.
Tell us, what is it that your clients most want to know? What do they most commonly ask you today when it comes to real estate and the real estate markets?
Yeah, well, a lot of times we'll have conversations about real estate and folks are always enamored by it. They always have been. And so one of the things that they ask if they have excess money is, should I buy a rental property or should I, get involved in a rental property or make my house an Airbnb? That's becoming even more of a consideration these days. And there are lots of things to consider. Sometimes I just ask them, hey, do you like fixing toilets in the middle of the night? Are you okay being a property manager? Those kinds of things.
Yeah. If you have to hire a manager, it eats into the profits. Absolutely. Jeff?
So with the markets at all-time highs, Michael, the stock markets, the valuations are, the all-time peaks of peaks. What we're seeing is a migration into hard assets like real estate because interest rates are so cheap. And so do you think it makes sense for retirees to have income-producing properties to complement their income in this environment, just so they can also diversify into hard assets because the market valuations are pretty steep?
Yeah, that's a great question. And the answer is maybe. It really depends on the person these are the reason I answered your question the way I did earlier a minute ago, Dave, is because people have to do a little soul searching because, like I said, they're enamored by real estate. The real question is, are you comfortable in managing a rental property? Because the reality is, if it's chosen in the right location, under the right circumstances, with the right financing, then you can actually get a really nice return on investment for the money that you invest. So it could be very good in in this current environment and provide some good cash flow. But there's no perfect investment out there, so you have to take the good with the bad, and you have to deal with those potential skeletons in the closet if you're actually going to take on those types of investments in your portfolio.
Those are all really good points, Mike. And with interest rates being this low, the break-even proposition on a second or third property got a lot better because the cost of money is so cheap.
That's right. And we always look at, the return on your cash investment. That's what you want to make sure, because we're talking about cash flow and our clients need income. So making sure that the money that you put in or the money that you get out is worth the money that you put in.
Sure. When we come back from the break, Michael, I want to ask you about real estate investment trusts, because for those people who don't want to fix a toilet, a lot of real estate investment trusts are still down in value significantly. And some find it to be risky, some find it to be a good opportunity right now. So I want to get your thoughts on that. Meanwhile, you're going to want to stay with us to hear what Michael Eastham thinks about real estate right after the break, right here on Income Generation. I'm David Scranton, and we'll be right back. Welcome back to the Income Generation. I'm David Scranton. I'm so glad to be here today with my two good friends, Jeff Small and Mike Eastham. Mike is founder of Fellowship Financial Group, a retirement income store located just outside of Orlando. So, Michael, the individual investment properties, you're right, it's a personal question whether somebody wants to complicate their lives with a rental property, and there's risks. I have a new client who's actually a regular viewer of the Income Generation who's down here in Southern Florida, but has, I can't remember, 4 or 5 rental properties up there where you are in Orlando. And with fewer people traveling to the theme parks, those properties have gone unrented. So there are risks there. But most real estate investment trusts really have corporate tenants. They're stock of a company that owns real estate and generates rental income, whether it's through retail, whether it's through office, long-term care facilities, and so on. What are your thoughts right now on real estate investment trusts as an investment opportunity for our Income Generation members who are looking for income?
Sure. For certain clients, it can be a great opportunity because they do tend to pay higher income. It's just their nature. You see, the thing you need to understand about real estate investment trusts is that they get some benefit. They get some benefit of not having to pay corporate income taxes. The way that they get that benefit is because they promise to pay out at least 90% of their earnings to you and I in the form of a dividend. So by nature, they don't retain much of their earnings. They spill it all out to us. So it's a great opportunity for them. They don't pay corporate income taxes. For us, we get a little bit of a higher dividend. And in some cases, it's a lot higher dividend. But you're right. There are different risks in there because you are purchasing the stock of a company that owns real estate. So you have to understand that aspect of it. But there are good real estate investment trusts and there are poor real estate investment trusts. You've got to make sure you understand the entire spectrum and make some good decisions about which ones that you're going to add to your portfolio, if any at all. Because
one of the things you got to be careful of, Michael, right, is publicly traded versus non-publicly traded real estate investment trusts. Sometimes people don't understand that there's 2 different flavors and there's a big difference between the 2, right?
Absolutely. And for the most part, we just kind of stick with the publicly traded ones because they're much more transparent. They are relatively liquid if you need your money. But the downside is that with that liquidity flexibility comes the fact that you're probably going to pay over par for the shares. But at the same time, for the flexibility and the income, I think that for most of our clients in the Income Generation, that they could do very well using some component of real estate investment trust.
As an advisor, they're not going to pay you the huge commission they pay to brokers, but you're much better off with the liquid real estate investment trusts that don't pay that commission but are much more transparent, I believe much better for the investor. You concur, Jeff?
I do, and Mike, that alleviates the biggest headache of being a property owner. You don't have to answer the call in the middle of the night to get the maintenance man to fix the toilet or the light switch. And so, real estate investment trusts do pay pretty high dividends though right now. And so there's some good ones out there, but obviously there's the ones that we want to avoid in the commercial sector, because some of the commercial sector and the real estate side is getting shellacked due to what's happening in corporate America and the downsizing and people working from home type styles. And so those are things that we ought to be made aware of. So all great points, Michael.
Yeah, no question. Including, you look at hospitality industry. There are some REITs that are out there that got pummeled because of the fact that all they have was, certain things in the hospitality area. So you want to make sure that you're pretty careful about that. And of course, shopping malls are another one you want to be very careful about in this environment.
Well, I don't know. I mean, can't Vicky wait till the pandemic's over so she can go back shopping? I mean, isn't it true that there always be people that go to malls that, just it might be subdued now? Or do you think that this trend that we're seeing right now of everyone buying things through Amazon that accelerated with the pandemic, do you think that's just going to continue and continue to hurt shopping malls?
Well, I think it will. We will see a downsizing of some of these malls, but these mall owners, a lot of them, especially the very large ones, like Simon Properties, for example, they're a huge REIT. They're looking at repurposing a lot of their malls and using alternative businesses coming in there, and that's actually going to work out pretty well. I think there's a lot of great opportunity if you think strategically, and some of these REITs that have gotten hurt are actually doing just that.
Yeah, they've got to get creative. You're right. The good news is that most REITs are diversified, if not nationally, they're at least diversified regionally, so that you don't have the issue that my client has, where if you happen to be lopsided and have 4 or 5 rental properties right outside the theme parks in your backyard, you have diversification in other areas. So, as usual, Michael, thanks so much for being here with us, and thanks for your words of wisdom. We appreciate it.
My pleasure.
And you stay with us. We have more coming up here in just a moment, right here on The Income Generation. We'll be right back. Welcome back to The Income Generation. I'm David Scranton. And I want to take a few minutes and just wrap up today's show about the housing market with some closing thoughts. Owning a home is an important part of the American dream for almost everyone. It's also one of the most important financial decisions that you'll ever make. So it's always a good feeling when the housing market's strong. Unfortunately, today's housing market is more than strong, and it started booming in 2020, both in spite of and because of the COVID-19 pandemic, and is expected to keep booming for the most part through 2021. Most analysts agree that it's not a bubble that's destined to pop, but simply another economic silver lining in the dark cloud of the pandemic. It's seen as a pillar of the economic recovery and a sign that the recovery can and will continue. However, if there's one certainty about today's financial markets, it's that nothing is certain. There are factors in place that could cause the housing boom just to go bust, just as there are factors that could trigger the next big stock market correction within the next few months. The important thing right now is to make sure that you have a financial strategy that prepares you for these possibilities, one designed to help protect you from potential losses and to help you take advantage of potential new opportunities. I'd like to take a minute and thank our guests today, starting with Dr. Ben Carson, but also our good friend, Mike Eastham, as well as my good friend and co-host, Jeff Small, all for joining us today right here on The Income Generation. I'd also like to thank you for tuning in today. And remember, if you're close to or you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week. know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information about the financial markets, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And we want to help make 2021 the year that you achieve and maintain your financial fitness. We're offering our loyal Income Generation viewers and listeners a complimentary 12-month trial subscription to the newsletter. So don't delay. This offer is only available for a limited period of time. Visit RUFinanciallyFit.com to claim your free one-year subscription.